Okay. Good afternoon, and thank you for joining us for today's presentation. My name is Brian McGann, and I'm the Head of Investment Strategy at Beacon Trust. Let me introduce my colleagues that are joining today. Susan Hayes is the head of our Fixed Income Group, and Dr. John Longo is our Chief Investment Officer. Within the past few weeks, we've eclipsed the 12-month low for financial markets and the economy, and now we sit at record highs and are set up for robust economic growth. An interesting year on many fronts. For those of you who joined our webinar on January 28th, you may recall that we outlined some broad predictions for 2021 for the US economy, equity markets, Federal Reserve policy, and interest rates. We also outlined some points around the post-election investment landscape. Today, with the benefit of time, we'll be able to hone in on some of these in much greater detail. John will kick off the presentation with a review of the quarter, market performance, and also touch on the reopening of the US economy. Susan will then provide some insights on Federal Reserve policy and the implications of what transpired over the quarter with the rise in longer-term interest rates. We'll conclude, as always, with some risks that we keep our close eye on, and then have some time to address your questions. The logistics for today's call are as follows. All participants are on listen-only mode for the entire presentation. Should any questions arise during the call, please type them within the Questions tab or use the chat function. The slides that we're covering today will be sent via email for those who registered. We're also recording today's call and we'll be posting it to the Beacon Trust website. Finally, we always appreciate your feedback and are always looking for ways to improve our communications with our clients. Please feel free to send in emails with any comments you may have into our customer service mailbox. Thank you all again for joining, and I'll now turn the presentation over to John.
Thank you, Brian, and thanks everybody for joining us. It's a beautiful day out today on the East Coast, and it's really been a beautiful year for the market. Imagine we were here a year ago, near the depths of the pandemic, and I told you 1 year from today, or where we are now, we'd be up 65%. You wouldn't believe it. You thought it'd be a bad April Fool's joke, but yet here we are. And yes, we're concerned with how quickly the market has risen, but we're still reasonably optimistic. We don't want to get too bearish too quickly ahead of what we think is going to be the strongest economic growth in most of our lifetimes. So with that little segue, let's kind of recap what's happened over the quarter. So the winners this year kind of were the laggards last year. So looking at the top half of the screen, small cap here shown in the green is up an incredible 20% in the first quarter. Somewhat outdone, we have value stocks, which clearly lagged last year, up around 12%. S&P up around 6% with dividends. And a lot of those stay-at-home stocks, the growth stocks, they're up a little bit, but clearly not the performance they had. So one of our lessons that we continually give in our webinars is to have a long-term horizon. You can see at the bottom of the screen here, we had a terrible drop here with COVID, rebounded strongly. And this is why we always have a diversified portfolio. And Susan will discuss our fixed income outlook and why we have fixed income. But having a diversified portfolio gives you the confidence to stay the course, even crazy times like this drop, and of course, the subsequent recovery. One of the reasons the market has risen so strongly was, number one, of course, the development of the vaccine. And now we have 3 out there and hopefully 4 or 5 soon. Roughly speaking, you can see this map. And if you're interested in tracking this, you can kind of search on Bloomberg Vaccination Tracker. And roughly at a big picture level, about 25% of the country has had at least 1 dose. You can see here we have 167 million doses. And obviously some have had 2 doses and so forth. And we're really ramping up pretty strongly, around 3 million per day. Here in New Jersey, they announced that children age 16 and over, young adults, can now be vaccinated within a few weeks. So we're making great progress, and that's helping open up the economy, which of course ties to earnings and stock prices and everything else. Another driver of the strong performance has been the $1.9 trillion stimulus. I know it's easy to lose track of all the stimuli we've had, but the $1.9 trillion has recently been unleashed to the economy. Not all in one burst, but it's getting out there. Of course, the headline was the checks to many individuals making under $80,000 a year, including, for example, a family of 4 with 2 children. You could have gotten a stimulus check over $5,000. That was the headline, but Susan's going to touch a little bit on municipal finances. So governments, especially those, let's say Illinois, New Jersey, others that had some deficits, really got a much needed shot in the arm, kind of pun intended. And there are other things as well. We're going to be talking a little bit about infrastructure, so money going towards transportation. For those that have been in New York City, the subways haven't really run too much. They had a revenue shortage. And then things like cleaning classrooms, cleaning public spaces. And you can see what else we have here, but it's really a multifaceted stimulus that is resulting in part of the growth that we're seeing. Now, I kind of did a little bit of homework. GDP this year is expected to be on the low end 6% and on the high end up to 10%. So let's put that in perspective. The highest GDP since kind of those numbers was 1984. We had 7.2%. Before that, in 1950, we had 8.7%. And the highest quarterly number we had was Q4 1950 of 13.4%. So as I said at the top of the call, we are probably seeing the strongest economic growth in many of our lifetimes. And therefore, we don't think we want to get too bearish too quickly and really pulling our horns, so to speak, with all the equities that we have and so forth. And you can see the US is leading the pack, China's doing well, and India, kind of the emerging markets, the US, and Europe is lagging. But as the vaccinations roll out, we expect this to be kind of a global recovery. Now, there's a lot going on this graph, but let me kind of break it down for you. You're probably wondering, well, which parts of the economy are back to normal and which are still having a little bit of problem? Well, let's kind of look at things that we all kind of experience, right? Eating in a restaurant. Well, during the peak of the pandemic, it was banned. You could do takeout, but you couldn't eat. Now it's down about 37% from the peak. Now this is not uniform. We have some states like Texas and Florida that are largely open for business, while in New Jersey, New York, we're about, let's say, 25 to 35% capacity. And just looking kind of down the line, airport travel is down about 50%, and that's kind of dropping rapidly. We're getting close to normal rapidly, not quite yet. Think about you using, let's say, your Google navigation app. That's down about 28%. And then we look at other things, mortgages. It's been a boom market for the housing market. And this overall number, down 3%, might be a good estimate of the overall economy, of where we were versus January of 2020. So there's a lot of implications for this. One, we're not quite back to normal, but two, I'll show you a screen on earnings. And the earnings of these companies that have been decimated, travel companies, think about Boeing, hotels, they're not back yet. And then we think 2022, they'll be closer back to normal, and therefore the market may not be as expensive as it appears. But I'll get to that in a moment. So yes, we are a little bit concerned that the market is expensive on most valuation metrics. I'm not going to go over all of these, but you can see in the inset box here, there's about 5 or 6 valuation metrics. And the only one where stocks seem to be undervalued are comparing it to the yield on bonds. You may have heard that acronym TINA, T-I-N-A. It stands for there is no alternative. So one reason why the stock market has gone up, as well as other risky assets, is that you're not really getting paid much for putting your money in the bank, and really you're underperforming on an inflation-adjusted basis. So yes, stocks are expensive, but this isn't the internet bubble of the late 1990s. During the internet bubble, we had companies like AOL with very minuscule earnings that were leading the market. And in recent, let's say the past year, we have the FANG stocks, and these are real companies, Facebook, Amazon, Netflix, Google. Maybe they're a little bit expensive, they are solid and probably good long-term holds. So this is the point I alluded to earlier. Last year, earnings fell off the cliff, especially for those companies that were impacted most by the pandemic. I mentioned Boeing, some of the travel companies and so forth, and were expected to bounce back pretty strongly this year. But it's really next year then I think earnings will be in full force. And we can talk about some of the risks with taxes. I'll touch upon that near the end of my talk. But this is one reason why we don't want to get too bearish. You probably heard the S&P cross the 4,000 threshold. So according to these estimates, that's about 20 times earnings. A little bit expensive, but when you have low interest rates, a growing economy, it's not that expensive. And as we always say, it's kind of a market of stocks, not a stock market. For a lot of the inflated stocks, let's say some of the companies in the electric vehicle chain, there are some really, I think, undervalued stocks. We talked about General Motors, for example, in our investment committee meeting today. And that stock has a forward PE of about 10 and has a lot of growth potential in electrical vehicles and other things as well. So with that, I'm going to hand it to my colleague, Susan, who's going to give you our outlook for fixed income.
Great. Thank you, John. So as John explained, the economy is sort of turbocharged right now with the quicker vaccine rollout and the large amount of stimulus that's come in to the marketplace in a very short period of time has led the Federal Reserve to upgrade their economic projections. So this chart is a really nice way of looking at it. It has projections from September, December, and current projections. And you can see probably the starkest upgrade to their projections is in GDP. So the lower left-hand side shows their prediction for where they think GDP is going to be. And if you look in the orange, in September, it was around 4%. December, it creeped up a little bit. But as John just mentioned, the GDP projection by the Federal Reserve is around 6.5%, which is the strongest since 1983. So obviously a huge jump up in GDP expectations based on all the economic fundamentals that John mentioned before. Some private economists even have the GDP number coming in around 7%. So undoubtedly a huge GDP number that we're looking for probably in the second half of this year as stimulus is fully rolled out and as more people are vaccinated. But the interesting thing is if you look to the right of that, the GDP expansion doesn't keep going on and on and on. It sort of moderates going into 2022. So their projections are, a little bit higher in the blue line for the current projection, but it's still sort of in that it's around 3%, 3.3%. So even though GDP goes up very quickly this year, it does moderate into 2022 and rises, although at a much more moderated pace. So in the middle, you have their unemployment forecast. So as the economy reopens, as restaurants reopen, as Disney World reopens, more people will go back to work, and that will bring down the unemployment rate. So you see the projection has come down steadily. For the end of 2021, the projection for the unemployment rate is 4.5%. The most recent number we got on Friday, which was a very good jobs number, was 6%. So that means that the Fed is expecting that the unemployment rate will come down another 1.5% by the end of this year. That trend continues into 2022, where they have unemployment being at around 3.9% for the end of 2022. And Treasury Secretary Janet Yellen said yesterday that she believes that the economy could be back to full employment by the end of 2022, which is a good sign. On the right-hand side is something called a PCE, personal consumption expenditures. That's the Fed's preferred inflation measure. And what we're looking at here is the core measure of it, which strips out volatile food and energy. Inflation is obviously a hot topic. It's been in the news quite a bit lately. There's a lot of people in the camp that inflation is going to take off like a rocket. We're going to have hyperinflation. And a lot of economists are saying, no, not so fast. We will have inflation that spikes up, but it will moderate over time. And this Federal Reserve projection actually illustrates that pretty well. By the end of 2021, this year, where you have, on the left-hand side, GDP going up so much, they do anticipate the inflation number getting above their goal of 2% to end 2021 at 2.4. But again, sort of like the GDP number the next year, inflation, according to predictions, and this isn't reality, things could change, inflation could certainly be higher, but they have a projection of the inflation number being around 2% at the end of 2022. And if you extrapolate that out one more year, in 2023, they have 2.1% for inflation. So certainly not runaway inflation and centered right around their 2% stated goal. So the Federal Reserve, along with Treasury last year in March and April, during the depths of the market crisis, when even the Treasury market was seized up, came in and really helped financial markets find stability and help financial markets recover. And the Federal Reserve has said for a full year that they will continue to be accommodative. They say it over and over again, oftentimes in the same exact language. So on March 17th, again, after the Federal Reserve decision, Chair Powell mentioned again that they are going to be committed to using the full range of tools until maximum employment and price stability, which are their dual mandate, are reached. Again, a week later, he said that they will support the economy until it's all but fully recovered before they pull back monetary support. So what does that mean? It means that the Federal Reserve has committed to keeping the Fed funds rate at 0. So that's their benchmark overnight lending rate. They've also been purchasing $120 billion a month in Treasury bonds and mortgage-backed securities. That serves to stabilize the bond market. So they've been purchasing 80 billion of treasuries and 40 billion of mortgage-backed. And also, they have a new inflation policy where they're okay letting inflation run a little bit hot or above the 2% goal in order to achieve 2% over time. So those are the sort of real world things that they're doing and that they're are committed to try to keep the economy on track and to help the economy grow. So again, talking about inflation, because it seems like it's everywhere. Inflation expectations have been rising, as we saw at the PCE chart. Inflation expectations for the end of this year are higher than they were even in September and December. So this is something called the break-even, the 5-year break-even rate of inflation. This is where market participants see in 5 years inflation being, and you can see that inflation was in a range from 2016 until recently. It sort of broke out of that range because the economy is reopened. There's a lot of pent-up demand to spend. So that's something we're going to have to watch. That's a fairly new phenomenon. And when people talk about inflation rising very quickly, this is one of the metrics that they're talking about. So, if inflation stays elevated for quite a period of time, it could force the Fed's hand and make them possibly taper or raise rates maybe sooner than expected, but that's something that we'll have to watch for. So again, keeping on the theme of the Federal Reserve and inflation, as I mentioned, the Fed doesn't see runaway inflation at this time. We don't think at Beacon Trust that we're going back to a period of time where we have double-digit inflation numbers. Yes, inflation could maybe hit 3% for a quarter or two. We will have near-term spikes in inflation, based on the reopening and all the things I've just covered, but then we think it will moderate over time. As I just mentioned, the Federal Reserve put this new policy framework into place in August and are okay with running hot. So if you have a 3% CPI, which is another indicator of inflation, if you have a 3% print, they're okay with that because they're looking to average it out over the longer run. The Federal Reserve has also said over and over and over that they will communicate clearly to the markets before they're ready to do any sort of tapering or rate changes to let the market get used to it. And again, the other thing that has been mentioned is that they have the tools to address price pressures if needed. Again, this is a sort of thing where they have their stated talking points on it. Both Treasury Secretary Yellen and Fed Chair Powell are in sync on this. They are tending to repeat the same thing over and over again, that they're not worried by uncomfortable or unwanted inflation, that too low inflation is a bigger problem that they perceive right now. So this chart is something that I look at every day. I stare at a Bloomberg screen, so I'm always looking at Treasury yields. 10-year Treasury is a benchmark. And I like this chart because it shows on the bottom line in the green sort of dash line where interest rates were in August. This is when the 10-year Treasury hit its low at around 50 basis points. So you can see during that period of time, interest rates were fairly low, and you didn't get a lot of extra yield to go out very far, meaning that the curve was what we call flat. You don't get a lot of extra income to compensate you for going out very long. The middle line is at the end of the year last year. So President Biden had won the election, so the Democrats are going to be in the White House. He had talked vigorously about his stimulus plans. It was also around the time that the Georgia elections were getting closer and closer. So the possibility that there could be a united government was in play, and that, inflation expectations were increasing. So that served to raise rates a little bit also. But really, after, the vaccine rollout, the last line on the top is from last week. After the vaccine rollout, after, the United government, the $2 trillion CARES Act, this new $1.9 trillion on top of potential infrastructure really turbocharged the bond market. And in a 3-month period of time, essentially the first quarter of this year, you had 10-year Treasury rates go up about 80 basis points. So definitely a big move in Treasuries in a very short period of time, but I think it's always good to look at it in context where we were and where we are now. We don't expect Treasury yields to continue to rise at the same pace that they have been. We expect them to moderate. For the last week or two, they've been sort of trading in a range. There could be another leg up, but we don't think that the Treasury bonds are going to continue to rise as fast as they have been. So talking about the bond market and credit quality is obviously a big part of what I look at in my day-to-day when I'm picking bonds for our clients. So when we look at the tax-exempt market, and how tenuous it was even a year ago, right? We had a complete shutdown of the economy. Revenues were decimated, sales tax revenues, wondering if property tax revenues were going to go down because people were going to lose their homes, as they did in 08, 09. It turns out that the revenue situation for most municipalities wasn't as dire as initially predicted in the spring of last year. But there are a lot of municipalities, especially the states that were harder hit, like in New York and New Jersey, that bore the brunt of the negative economic momentum. But this $350 billion that John showed you on one of the first slides that was allocated to state and local governments is really enough stimulus to almost plug the pandemic hole in most areas. New York State will still have around a $2 billion budget gap. I think New Jersey is close to being made whole. So this massive windfall, and you can't call it anything other than a game changer or a windfall for municipalities, is really going to help municipalities repair their balance sheets and be able to spend on things that were sort of maybe wish list items. On this massive stimulus, Moody's Ratings took the entire sectors of state and local government and municipal bonds. It probably comprises, 20,000 or 30,000 different issuers. In one fell swoop, they went from negative outlook to stable outlook. So if you have a major ratings company, take that much of a sweeping action, it shows you that this money was definitely needed and will go to solving a lot of problems. So when I look at corporate bonds, the credit picture is also good. Federal stimulus and reopening are positives for corporations, and the low cost of financing and tight credit spreads are going to continue, we think, in 2021. So as far as our interest rate outlook for the rest of the year, we do think that because of the vaccine rollout and all of the stimulus, those are sort of game changers. The speed with which the vaccines are being rolled out is surprising to a lot of people. It's been going very well, I think. New Jersey, is just sort of getting on board. They've announced 16 and older. The amount of stimulus is massive, no doubt about it. So all of those things potentially brought forward our predictions to where we thought interest rates would be for the end of the year. So now we're calling for the 10-year Treasury to be around 2% at the end of 2021. This chart below is something interesting. You may have heard it on CNBC or Bloomberg. It's called the Federal Reserve dot plot. And what it is each dot represents a member of the Federal Reserve Open Market Committee and where they think that interest rates will be at the end of the year. So if you can notice 2021 are all clustered around that 0% rate. So that means that, as it's predicted now, no members think that we're going to raise rates in 2021. If you move out to 2022, there's a couple people that think that because of the swifter economic rebound, there's potential that top dot that John's circling now is actually calling for 2 rate hikes in 2022. So you have more members sort of thinking that there might be potential. By 2023, there's a few more members, but it's still not a majority. So you can't say that a majority of the Fed members think that interest rates are going to go up. But if you look longer term, and that's 2024 and beyond, everyone on that voting committee thinks that interest rates will have risen by then. So, sometime between 23 and 24, it's always possible. These are forecasts. These are not outcome based. So it's always a potential that it could be brought forward. But as of now, as of the last Federal Reserve meeting, this is where the dot plots are. So what does all this mean for fixed income? Higher rates, inflation, credit cycle in fixed income. For us at Beacon Trust, we've always built portfolios to be more conservative, to serve as preservation of principal, and our maturity and duration structure reflects that. So we've tended to always have a kind of a shorter maturity structure and duration structure in our portfolios, which tend to be more defensive in a rising rate environment. So that structure really helped us in March and April of last year when there was a lot of market turmoil, and it also helped us be really holding our own against our benchmarks in this first quarter of 2021. We do still think that fixed income is a necessary part of the overall portfolio. So just because interest rates are going up does not mean that you should have no fixed income in your portfolio, especially if you're near retirement age or at retirement age. Bonds will continue to provide income, but total returns may be muted for a couple of years as we expect on a firm basis that equity returns will outpace fixed income. But the bright side is that higher yields offer a more attractive entry point, and you have higher reinvestment income. So if you have a bond that's maturing over the next year, 2, 3, you most likely will be reinvesting at higher rates than you certainly would have been over the summer, and we think that's a positive for fixed income. So with that, John, I'll hand it back to you.
Thank you, Susan. There are always risks. You may have heard that expression, the market climbs a wall of worry. I've mentioned the 65% gain we've had over the past 12 months. And of course, at the top of our risk list has to be the unknown path of COVID. We've seen the numbers trending in the right direction. I know the font's a little bit hard to read, but I can kind of sketch it out for you. On the top graph, we have the daily number of infections, as well as testing, and you can see this curve over here. Here's where we are, at least when we printed the graph. And under a worst case scenario, let's say variants of the COVID strain aren't covered under the vaccines, we could be over here. We are projected over here in this kind of reddish purplish screen or dot plot. And then if we continue doing social distancing, wearing masks as appropriate, we can get to normal recovery even faster. On the bottom screen is obviously a more serious condition, the number of deaths. And the good news is that we've been dealing with COVID for over a year. We know how to treat it a little bit, both in terms of medication and other things as well. And you can see here's where we are. If there are new strains that the vaccines don't work, we can go over here. But if we continue to social distance, have improvements in the pharmaceuticals, as well as not be capacity constrained in our hospitals, we can continue to lower that curve. So overall, it's likely heading in the right direction, which is, I think, one of the reasons the market is heading up so strongly. But it's not over till it's over, as Yogi Berra said once. The second one, I've ripped some headlines from Bloomberg and other sources about elements of political risk. Probably at the top of the list are kind of the battle of the titans, the two largest economies. Probably before my time and some of your times, you might remember the tension with Russia and the US after World War II. It maybe came to a climax with the Cuban Missile Crisis. Russia is still there. I'll get to them, but in terms of economic threat, it's US and China. North Korea, we had some progress on that a few years ago, and what a difference a couple of years makes. So now North Koreans President Kim is saying the US is the biggest enemy. They've tested some missiles, and we'll see how that shakes out. You may have seen an interview with President Biden where somebody asked him, do you think Vladimir Putin is a killer? And he said, yes, I would agree with that statement. So clearly some tensions going on there as well. And the tensions aren't confined to the US and the rest of the world. Within the EU, if you follow that, there's been some tension in rolling out the vaccine, especially with AstraZeneca, which is a UK firm. So there's always political risk. It's always generally, I think, a short-term thing, but it can result in a very steep correction, in some cases, bear market, but they tend to be shorter than bear markets set off by recessions. Perhaps the highest probability risk that I think will maybe unfold near the end of the year is higher taxes. Both Susan and I alluded to the enormous stimulus that is in the economy, that's making its way into the economy. There's another infrastructure package that's being heavily debated. We think something's going to get done on infrastructure. And of course, the flip side of the spending is how are you going to pay for it? And the answer, part of the equation has to be higher taxes. So what do we mean by that? Well, we think there's going to be higher corporate taxes, probably rolling back half of the tax cuts that President Trump and Congress came out with about 4 years ago. We think there's going to be higher individual taxes. President Biden has said anyone, and I think this could be couples as well, making over $400,000 a year will see an increase in taxes. You might have to go lower than that. We'll see how that shakes out. And then consumption. So that could be a sales tax. It could be like in Europe, a value-added tax. And in our investment meetings, we've even shared some articles where, at least in the state of New Jersey, perhaps they would track how many miles you drive per year and give you a tax on that. So we'll see how it kind of shakes out, but there is an important takeaway from the graph. So here's debt over GDP. And yes, we were in this situation at the end of World War II. But at the end of World War II, we had perhaps the greatest growth in the history of the US, maybe absent the early stages of the Industrial Revolution. And yes, we are going to have kind of rip-roaring growth this year, anywhere between 6 and 10%, but then it'll quickly revert to the normalized 2 or 3%. And you can see here we have a high budget deficit as a percentage of GDP. And right now the numbers don't seem too bad because interest rates are quite low. We call this the carrying cost of debt. But imagine if the 10-year spikes at some point, let's say we go a couple of years down the road to 3, 4%, well, then it becomes a much bigger part of the budget deficit. And then we'll be looking at even higher taxes or cuts in entitlement programs. So this is a serious long-term risk. We think it's highly unlikely they're going to make the taxes retroactive in terms of paying something this year. Let me just kind of summarize before we do Q&A. So what does it mean? Well, as I said at the top of the call, pretty much all of our clients are in diversified portfolios. And those portfolios are there for a reason. They are designed to help you stay the course during extremely volatile times like we saw in March and April of last year. And you can go back and look at our calls, look at our writings, and our message was clear. Yes, have 6 to 12 months of money in cash and an emergency fund, but the rest of it, leave in your diversified portfolio. And frankly, it did turn out better than we expected. I don't think anyone expected a 65% rate of return, but we thought that this was a very severe, but yet temporary recession. And then we saw the massive stimulus and Fed and everything else that helped drive where we are today. So be diversified. Within the equity space, we think there's a normalization of returns. So what that means is that the incredible performance of some of these growth stocks last year, not that we're abandoning growth, but we think they're likely to normalize. And we think that the leaders may continue to be in some of the areas that were beaten up last year, whether that's value, small cap, international. As Susan mentioned, the fixed income space, we still prefer high quality. We still prefer lower duration, which means shorter maturity. If we were to see interest rates spike dramatically, we might lengthen the duration. And we like high quality. I think that's a good way to, kind of sleep easy at night. And with that little summary, I'm happy to answer your questions with my colleagues.
Thanks, John. Thanks, Susan. We did have a couple questions come in via the chat function. We'll get to those. A couple, though, to address. And I know John, I'll start with you. You touched on this a little bit about the market and on the equity side and the valuation perspective. Mm-hmm. And so the question there, given that the market is a forward-looking mechanism, has it already priced in the post-COVID recovery? And how much more upside can we expect?
Yeah, it's a good question. Clearly, it's priced in a good recovery, and it's priced in substantial part of the recovery that we've had, but I don't think it's priced the full recovery in. So kind of looking ahead to the end of the year, I think we could probably be up another 5 or 6% from where we are. Okay, it's not as exciting as the 18% last year and the 6% this quarter, but I think when you look at equities versus bonds, we could be there. And I keep mentioning it's a market of stocks. So would I be buying stuff in the electric vehicle space? Maybe not. I mean, we have a position in ARC that has Tesla, but clearly when you're looking at stocks with a PE of 50, 70, 100, I'd be very cautious on that. I would put that in what I call the risk bucket of your portfolio. But I look at other sectors. You can look at healthcare. You see high quality companies trading at less than 15 times earnings. We mentioned GM. You look at some of the financial stocks. So I see pockets of froth, but also pockets of value. And I would skew towards those value. And we also like the term growth at a reasonable price. We're excited about many of our growth names in the core and TLFI and other strategies. So I think it is a stock picker's market. Just to get into the weeds a little bit, I track a number called correlation within stocks of the S&P. And when the market falls apart, everything moves in unison. The correlation approach is one. But the correlation currently is about 20%, which is on the lower side, which tells me that being a good stock picker will really add value. And frankly, we've had good performance across all of our strategies. Brian mentioned that in our investment call today, and we're happy to discuss in detail on a face-to-face basis.
Yeah, and one point that I'd like to make too, it's, you had mentioned our writings over the course of the year and things like that. And one of the things that we started to talk about amongst ourselves and then with clients back in September was the broadening out of the market. And not just, from a sector standpoint, but also a geography standpoint and also a market cap standpoint. So we've seen a tremendous rotation into small cap stocks, and international has picked up and added some value in more diversified portfolios. And stock selection doesn't have to be all about growth versus value. It can be a blend of both, and that's where growth at a reasonable price comes in. So if you looked at some of the market leadership since that September, October time period, it has been a little bit down the cap scale. It's been in a little bit more cyclical type of sectors. So industrials and financials and energy really came off the mat here during that time period. But we don't think that really it's going to come at the expense of, the traditional growth. So some of the more established, better business model technology companies that have led the way for quite some time don't need to be completely sold off for the market to continue to go higher. We're starting to see participation amongst some of those market leaders again as well. But the continued broadening, I think, again, is more healthy and more sustainable of a type of a market than a tightly led, few stocks carrying 100% of the performance type rally. So thanks for that answer, John. Moving on to, I think the topic of that's been on everyone's mind, especially through the first quarter, is the inflation conversation. And so a couple of questions rolled into one. We touched on the stimulus package, the one that was presented, the 1.9 trillion. We also had the December 900 billion, and now we have an infrastructure plan being negotiated about. So one question: why won't this massive amount of spending? Why won't it cause significant longer-term inflation, longer-term sustainable inflation? So Susan, from a fixed income standpoint.
Sure. Yeah, I'd be happy to take that. Yeah, I mean, I had a couple of slides that address that, but I think, we do see that it could cause transitory inflation. I mean, it just makes sense. If this massive spending's come into the economy after the economy is all but shut down, prices will go up. More people have pent up demand. They're going to be spending. But, we think we're going to see short-term spikes, but in order to have sustained, massive inflation, you have to have long periods of time that are very inflationary, and we just don't see that happening. When the stimulus isn't going to last forever. Stimulus is going to go into people's pockets. They're going to, spend it, do what they're going to do with the money. They could save it. There's a lot of different things that people could do with it, but over time, it will probably moderate. But I would caveat that and say it's an unknown risk, right? I don't think we've been in a situation like this, maybe one other time, maybe after World War II or something like that, that the economy is coming back after basically being asleep for so long. But I think the important thing to note is that the Federal Reserve can use monetary policy to tamp down what they call unwanted inflation. So, we think it's probably going to be transitory and moderate over time. But the Federal Reserve has a lot of tools, just like they use them to help the economy. They can use them if the economy is running too hot to try to cool them down. The one that everybody knows is the federal funds rate. So, the most well-known tool that they have in their monetary policy arsenal is that they can start to raise rates a little bit. That will have the effect of cooling the economy because it will immediately cool the housing market because mortgage rates will get higher. They have open market operations. So as much as they've been going in and buying 120 billion of mortgage-backed and treasuries every month, they can do what we call a taper. They can just let the bonds mature and not reinvest them into the market, which will make yields drift higher. Or they can go out and fully sell it back to, dealers on the street, and that will have the same effect. So, there's also the discount rate, charge a higher rate on, to allow banks to borrow, they allow banks to borrow from the discount window. So there's a lot of levers they can pull. And I think when you hear Powell and Yellen speak, they always say we have tools to combat higher inflation, but they never really say what the tools are. And I think those are maybe some of the most obvious tools they could use. But to your point, we do think there will be inflation. I'm not sure if it'll get to, significant point, because I think that the Fed has a vested interest in not letting rates get out of control. So don't forget, they have a lot of debt to service on their balance sheet. And if, interest rates spike up, they've got to service, debt at much higher rates. So, ultimately, again, it's something that's unknown at this point, but longer term, if you look out 23, 24, 25, we don't think that you're going to be sitting there at 5, 6, 7, 10% inflation.
Yeah, and I may argue that the economy can withstand a little bit more inflation than we currently have at this point, especially with the growth projections that John had mentioned before in the 6+% range. And we may get a little spoiled here with Fed funds at 0, bond buying program, stimulus coming out. But pre-pandemic, rates were higher than they currently are today, even with the rapid rise that we had throughout the first quarter. So, from a historical perspective, it's difficult to say that we should be afraid of a U.S. 10-year Treasury that's currently sitting at 1.65%.
Right.
So we could withstand a little bit more inflation, and that comes with better employment figures. And you mentioned the jobless number, the employment figures from Friday were fantastic. To put that in perspective, the economy created 900,000+ jobs. We could use about 10 more straight months of that to get the employment situation back to pre-pandemic levels. So a little bit of perspective always is a little bit helpful in situations like this. Finally, I think, and John pointed out, the third risk that we keep in the front of our minds here a little bit, but has really come to the forefront with infrastructure spending. And I think, again, pre-pandemic infrastructure was a bipartisan, agreed upon something that we should be spending some money on in this country. So, questions come in, a number of questions. So I'll combine them both. Given the likelihood of the Biden infrastructure spending bill, what are the thoughts about changing in the tax laws, and are they going to be retroactive? Are they going to go into effect in 2022? What are the other implications? So I'll start off, and then anyone else that can, and I know, John, you already addressed this a little bit, but from a tax standpoint, everyone on this call should know that we have a fantastic tax team here. So we obviously floated that question out to our tax team, and yes, the likelihood of the corporate tax rate going up is likely, and it's probably likely this year if they can negotiate some kind of infrastructure spending deal within Congress in some period of time this year. Whether it's 28% like as proposed, or somewhere in the middle like a 25%, that's going to create a little bit of angst. But I think from a company standpoint, companies would just like to know what the number is, and they can make their adjustments from there. So it is likely that tax rates go higher at the corporate level. On the individual front, that takes a little bit more political negotiation. So the likelihood, in our opinion, is that personal taxes won't be something that will be significantly on the table until the next tax year. So not afraid of any retroactive tax there. The longer the negotiations go on in Washington over the corporate tax, the less likely that they become retroactive. So again, don't think that it has much of an impact, but we'll be keeping close watch on that as we go throughout the year. And the implications are obvious from a corporate standpoint. The most immediate one that comes to mind is its impact on earnings per share. So we'd likely see a hit to earnings per share in the year of 2022. But again, the magnitude of that is yet to be determined.
Let me just add to the infrastructure. So the point I want to make is that not all spending is equal. So let's give an example. We're all kind of looking forward to the 4th of July, and let's say we spend money on fireworks. We enjoy it for that evening, but then it's gone. Conversely, if you spend money on broadband, bridges, roads, and tunnels, we have an improved economy, an improved machine. We should have greater productivity. So ultimately, there will be some return on that investment. And therefore, it's not going to be as bad as a tax hit as we might expect.
It's a great point. And also, the spending doesn't all come tomorrow. Even if they do sign the bill tomorrow, it comes over a number of years. So we have a chance to absorb some of that spending into the economy and adjust from there. All right, one final question, and this one I like a lot. What are the areas of the economy do you think that have changed forever as a result of this COVID crisis, and what opportunities and equities may exist as a result?
Good question. So clearly some things have changed forever. We're doing this call on Zoom. I think Zoom's going to be with us forever. For example, anyone with school-age kids will probably never have another snow day again, at least not too many, even just traveling into work. So there might be a smaller, let's say, corporate real estate footprint, maybe made up by other things like industrial space. I think most of us are comfortable with Amazon, but I think a whole new generation of people are like this delivery of home, whether of food products or other products. Telemedicine, I think that's going to be with us as well. I think many of us have the experience of going to a doctor's office and waiting around for hours. Wouldn't it be convenient just to do it at your home, assuming you don't need a surgical procedure? So I think there've been some very real changes, but I think ultimately it's going to make us stronger, and we'll come out the other side a better country, notwithstanding some of the terrible tragedies we've seen.
Yeah, it's hard to, the pull on the technology innovation from the COVID crisis, I think is one that has changed forever. And like you said, conducting calls like this and client meetings over Zoom or Microsoft Teams or whatever other virtual experience. I know you as clients know Beacon. We like to have events. We like to have in-person events, and we are so looking forward to the day where we're going to be hosting another in-person event. So more to come on that. But so some things. What are the opportunities? Again, I think it's sector-wise and it's asset class positioning-wise, as opposed to there's lots of risks, as we've seen in some of the more high-flying individual stocks, risks of to the upside and also to the rapid downside. So we'll evaluate those as we come along.
Yeah, and if there are periodic corrections, so Brian talked about some of the leaders, like there's nothing wrong with Microsoft, right? Microsoft is now approaching its all-time high, but for a while it was down about 15% just because of rotation of equity. So I think you could use drawdowns in the market to buy high quality at a relative discount. So that might be one more tactical strategy I would do.
Okay, this is really the last one because it just came in. And I promise, and we're bumping up on about 50 minutes, so I want to be mindful of everyone's in the audience's time. Can you please just reiterate the views on major indexes, Dow Jones, S&P 500 in terms of returns for the year?
So our outlook isn't that much dissimilar than what we said in the beginning of the year. So as you probably know, in January or really December of each year, we come out with a list of predictions, and then we have a call in January. And we basically said, because we had such a strong year last year, S&P up 18%, that kind of pulled away some of the returns from this year. So we said this year, maybe we're expecting return of 10, 12%. and we're about halfway there. So, what can kind of cause the rally to pause? Well, I think as the realization of higher taxes come to the fore, I think there's going to be a burst of spending, but once that burst happens, maybe the follow-up spending may not be as strong. So I think people will kind of go from this stimulus or sugar high and then look at the long-term fundamentals, which are okay, but they're there with higher taxes, a higher deficit. And as I said, I think there's some maybe better values in other regions of the world that money has to go somewhere. So we still prefer stocks over bonds, but we are aware of the valuations and the likelihood of higher taxes. So that tempers our outlook. But, I don't think we're going to have GameStop with the entire stock market, but, there's a lot of money floating out there. One thing I touched on, but didn't give a slide on, is that the savings rate has exploded. Many of us are in our homes and not eating out, and it peaked at 30% during the depths of the pandemic. And now it's still around 15% versus a long-term average of 5%. So those are just some thoughts, but we still like equities. And if you have cash on the sidelines, maybe you want to buy on a dip or a dollar cost average that in.
Okay, now I'm serious, but I love the engagement, so I appreciate the last minute. Let's get this one in under the wire. Present interest rate for 30-year tips, and if you do see any risk of increased inflation, do you recommend a small piece of that?
Yeah, I mean, we had actually, you want to know the interest rate on 30-year tips right now? Hold on one second. It's negative. Hold on one sec.
Sorry.
Sorry. 10 basis points. So 5-year, 5-year, 10-year are negative, 30-year are 10 basis points. I mean, we have been talking about tips quite a bit actually earlier this year. And, the problem with tips is the timing. If you have interest rates going up, because you have an underlying treasury, if you have interest rates going up quickly like they have been, your principal value is basically going down if you don't have commensurate inflation at the same time. So if rates go up, but you don't have commensurate inflation, your principal isn't actually, resetting higher. So you're not getting the benefit. If you look at the return on tips, and I was just looking at this earlier, they're down around 1.68% for the year, which is underperforming even our conservative, just on a total return basis, our conservative portfolios. So I think tips is kind of a timing issue. If I were going to buy tips, I would probably buy shorter tips. But, it's a timing issue with tips, I think. It seems like it would be a really good idea, and I've been sort of monitoring them for 3-4 months. John and Brian can attest to the fact that I'm always saying maybe we should put in an ETF form, because I think the tax consequences if you buy an individual tip are too complicated. So I would do it in ETF form, but it's just not there yet. But, in the third and fourth quarter, if we do see inflation spike up, it could potentially be beneficial, because as the CPI increases, your principal increases and you get the coupon payment on a greater principal basis. But, so far tips have really not been performing well this year. And I always sort of look at everything from a total return perspective, because that's how I manage.
Okay, that was it. Susan, thank you so much. John, thank you
Welcome.
so much. Thank you to our technology team, Dennis and Megan, for getting our technology all set up for this webinar. And thank you to the clients who dialed in today and took the time to spend listening to our views. Please, anything else comes up, please contact a member of your Beacon Trust team, and we certainly appreciate your business. And I really meant it. We are so looking forward to hosting an in-person event once again at some point, hopefully in the near future. So in the meantime, please take care, and we'll talk to you soon. Thank you.